Hi everyone, and welcome back to Finance with JCL. Here to help you on your investing journey to financial freedom. Warm welcome to you, particularly for those of you that are new to the show, so thank you for joining. If you consider subscribing, that will alert you to the next set of shows that I release. So today's topic is the debt to equity ratio, which is a key investing metric. Now, the reason for this show in particular is that when I'm looking at individual companies and assessing their suitability as an investment, I have a series of mandatory criteria that a company has to pass in order to be considered for investment. And the debt to equity ratio is one of those mandatory metrics. So that's why, but what are the three key takeaways for today? So first of all, it is to define the debt to equity calculation, which I will demonstrate with an example. Secondly, I'd like you to understand why it's an important metric, and then finally to understand what good looks like so you can use it in practice. So we start off therefore with the calculation or definition of debt to equity. So debt to equity equals the total debt divided by the shareholders or total equity. And the total equity there is your difference between your total assets and total liabilities. So you're effectively comparing total debt to difference between total assets and liabilities. And the way to read the answer or the result of that calculation is that a value of 2.48 as your debt to equity ratio would mean that there is $2.48 of debt for every $1 of equity in that particular business. And the information to calculate the figure can be found on all your usual balance sheets, so it's in that particular statement. But on most of the financial investing websites, they will calculate this figure for you as it's an important investing metric, so it should be pretty easy to find as you research individual companies for potential share purchases. So an example of a simple calculation would be company A, and their total assets figure is 20, say 20 million. The total liabilities on their balance sheet is 10 million, and therefore the difference between the two is a total equity of 10 million. Now, they had a total debt of 5 million. That would make their debt to equity ratio 5 divided by 10, so 0.5. So half a dollar of debt for every $1 of equity in that organisation. If you've got any questions about that, do drop them in the comments box. So in terms of using this debt to equity ratio in investing decisions, this is the key bit. What's the practical implication and application of that calculation? First of all, I'd like to say that my mandatory value has to be maximum of 2. So if it's above 2, I will effectively not invest in that company. And sort of the desired value is less than 0.5. Now, most companies do hold some form of debt, and debt per se isn't bad if you can get it financed very cheaply to enable an expansion that will return a greater amount of money than the debt. So companies do often have debt for those reasons, but you don't want that debt to be too high, and I prefer it in the perfect, wonderful company to be less than 0.5. Another quick trick you could do actually is if it's perhaps higher than 0.5, but the company has more cash in their balance sheet than debt, then again, that's probably nothing to worry about because they could pay off that debt if they needed to. So moving on, now this high debt to equity figure, 3, 4, 5, 6, that does equate to potential higher risk for that business because there are higher obligations for them to meet to pay back. You can find it on Morningstar and Simply Wall Street, which are two of the investing sites that I use to get my information. And perhaps good practices, taking all that into account, is not just to look at the individual company's figure and not just perhaps in that 1 year, look at the trend for debt to equity. In Morningstar, you can get 10 years of data sometimes, so has it been going up? Perhaps that may be more concerning. Is it dropping down as they pay down debt? But then also compare it against industry competitors. So if you're looking at Shell, you might look at BP. Compare the two organisations. How's the debt been going over a period of time? And what I'd urge you to do is, as you review companies and make investment decisions, keep a list, keep a spreadsheet of them, and keep a spreadsheet of these key bits of information, because as you do these reviews, you can kind of build up a data bank of companies and industries. So let's say if you're in the UK looking at insurance, you might be looking at Direct Line. But actually, if you've already looked at Admiral, if you've already looked at Aviva, if you've already looked at any of the other insurance companies, you'll then be able to compare the figures and trends for the company you're reviewing against the others to see actually which is the industry leader. Because sometimes it isn't obvious, especially if you haven't looked at any other companies in the industry before. So that's an important point. I suppose the key overriding factor here is debt itself, especially a small number, isn't bad or isn't obviously negative. But the key consideration is that it has to be paid back, and by paying it back, the company then will be using some of the cash that it generates from its operations, which rather than being returned to you as the shareholder, has to be paid back to the bank or whoever lent them the money. So the debt level being high will result in lower future returns for you as a shareholder. So that is the key takeaway. I think there's a famous kind of expression from Warren Buffett, the king of investors, where he says kind of companies with high debt, and then you have a bad economic time. It's a bit like being caught naked swimming when the tide goes out. So you're there, and you can see you're in trouble quite quickly. So these companies with high debts, when you have difficult economic situations, they can get in trouble quite quickly. So in summary, high debt can kill an organisation, and we have met our 3 objectives at the start of today's short show. So we have defined the debt to equity ratio and calculation, and I think we now understand why that's an important ratio, in particular because of the potential to reduce future shareholder returns with high debts. And what good looks like is below 2 and excellent is below 0.5. So that's it for today. I hope you found this really useful. If you smash the like button if you're watching on YouTube, that helps share this video with others. Please leave comments in the comment sections, and I hope you found this useful. And take your own advice as you go through investing. Have your own numbers. 0.5 is my threshold. It might be different for you. Do your own research and investigation and apply your own view. 0.5 is not a universal number. This is just what I use. So always have your own interpretations of these different metrics. So thanks for joining me, and I'll see you next time.